They're finally catching up to gold in terms of their own historic prior price highs. But I think they're going to lead from here on out in terms of percent gain. In fact, our projection is that basically over the next year or two, probably, the gold miners will triple in performance relative to gold. They're far better place to be. Silver will at least double in performance, if not more, than gold in this next phase. So yeah, gold is the mama. And when it comes out of this range-bound situation, it's been in since April, people will wake up and say, my golly, that's, I got to get in, 2,500, 3,500 gets taken out, for example. Then they'll wake up. Momentum says, don't wait. Already be there. But gold isn't the place to be. This time around, it's going to be silver, gold and silver miners. They'll vastly beat gold. If you go back and look at the 2000 or 2007 tops, we called it a tombstone event. It's after a period of no rate changes, usually prior rises, but then no rate changes, a lengthy period. Suddenly the Fed starts to cut. And this is when our momentum works. So the stock market's topped, it's no good. And finally the Fed comes in and you'll see a rate cut. In both those cases, one was in January of 2001, which was only a handful of months off the high monthly close in the S&P, which had been August 2000. And you weren't all that far off of it in price. So you really hadn't, for most people, it wasn't the bear market yet, And the Fed cut twice that month. Unexpected. And then, of course, the market just went to hell for the next couple of years. Okay, so it didn't matter. They cut all the way down. It didn't matter. Okay. For anybody who bought, and there was a rally after that, there were two cuts that month. They were buying into that rally. They go, oh boy, the party's on again. And of course, that was a tombstone of it. If you just sold into the market, then you'd done great. Sold right into the good news. Okay. 2007. Market made a high, S&P 500, at 1550, a few points above there, price-wise. Happened to be the same price high at peak in mid-2000. So it was up to the old 2000 price high after years of wasted time. And they sold into it, dropped down into the summer, came back up August, September, and mid-September, Fed cut rates by 0.5 point, which was a surprise rate cut. There'd been no policy change for quite a while. They suddenly cut rates. There was a 3-week rally that punched up through 1550 on the S&P, which means it took out the high of earlier 2007 and the high that occurred in 2000. So on a price chart basis, you sit there and say, oh boy, triple top breakout. Oh boy, party's on forever. Okay. If you shorted then, it was the top. Okay. They cut rates all the way down. The market went to hell. Okay, it didn't matter. Now we got a situation for a year there's been no change in policy, short-term rates.
The Federal Reserve finds itself in a familiar bind. After holding rates steady for over a year, Powell recently hinted at reductions, igniting optimism on Wall Street. Markets rallied briefly, but the excitement was short-lived. Current expectations price in a near-certain rate cut this fall, but the real question isn't the size of the cut. It's whether it will matter at all. History suggests once the Fed pivots, momentum damage is already irreversible. When the Fed cuts into weakness, it often signals not the start of a new bull run, but the confirmation that the prior cycle is ending.
And now Powell has surrendered. His speech last week was a surrender speech. In other words, he was saying, okay, I got enough Fed governors saying we need to cut. I got to agree now. We're going to do that. Okay, so they're going to cut. Question is a 0.5 point or what? Well, it doesn't matter. But the market rallied sharply late last week due to that speech. And party time. In other words, it's party time again. Oh, boy. And the rally, it was great for about a day, and that's about it. But it was already priced in to some extent because it was expected that they might cut in September anyway. 60, 70% expectation. Now it's 95 or whatever. So that's priced in. The question is this another tombstone event? Meaning, just circle it, be gone. This category is peaking. Okay. From our momentum perspective, where we look at price secondarily, but the long-term momentum of the market. You broke structure on a momentum chart that if you looked at the momentum chart rather than price chart, you said, oh God, we just blew the bridge. Okay. The rally back up since April low did not alter that. In fact, on momentum, it's to a lower high, despite price making a marginally higher high. So it's very important because I think this affects flow of money into certain other asset categories, namely, natural resource, gold, silver, monetary metals, even other more base metals. Whether suddenly there's a chorus out there, you can see it in some of the charts. And Momentum already said several months ago that, for example, it's time to buy copper miners again. It's time to buy rare earth minerals again, ETF. It's time to buy the lithium company ETFs, platinum stocks, and so forth. Platinum, which had not been moving with gold at all over the last years. And all of a sudden, all these metals, you throw a dart at them, they're all of a sudden moving up. Something's going on. A major asset class flow is occurring. And I think with the Fed panicking, as they normally do when their favorite asset, whether government debt or stock market, starts to break, they start to print more. The problem is for them, it never goes into where they want it to go. It's too late. It's already broken. It goes into gold and often into commodities.
Right.
And I'm seeing that in just too many places, especially in the metals complex. And not monetary metals, but the other ones. All of a sudden, they're waking up too. What's going on? It's not particular to lithium. It's not particular to the rare earths. It's not particular to copper. It's a flow across the board. That's interesting. It's telling.
While stock indexes still flirt with record highs, momentum indicators tell a different story. Much like in 2000 and 2007, markets are showing marginal new highs on price, but weaker internals on strength. This divergence is a classic warning sign of exhaustion. Beneath the glossy charts, money is already flowing elsewhere. Base metals, rare earths, and energy-linked commodities are breaking out of years-long slumber. Lithium, copper, and platinum are gaining traction, not because of isolated demand stories, but because capital is shifting out of equities and into hard assets. It's a quiet rotation, but a powerful one.
American investors invested in gold and silver miners is like, trivial. Still trivial. They haven't gotten the fever yet. When they start to get the fever, and it's already probably started, as you can see, since April, gold's gone sideways, steady, miners have exploded. What's going on there? Silver's exploded since where it was in April, okay? Mama gold is held steady. It's not a top, it's just a congestion zone. Meanwhile, the compatriots there have gone vertical. So they're starting to outperform again, which I think will continue. But a lot of stuff is going on that indicates asset class movement, including in the base metals. It's not necessarily specific to the metal, so you can look at the fundamentals of copper or lithium if you want, but it's really a more broad issue of money seeking a new place to be in an asset category that is vastly underpriced compared to other asset categories or even to itself. Silver, for example, $39 either side of it for a month now. Well, it was 50 in 1980. It was 50 in 2011. Very brief, phantom highs. If we matched those highs in real dollar terms, it would be $200 an ounce. So our projection right now is silver's likely to go through 50 this year and end up in the 60-70 zone by the end of the year. Not that that's a high, but that's where our working target is for the next surge. But we're starting to see that stuff in other markets, other metal markets.
Gold has held steady in recent months, consolidating near record levels, while silver and mining stocks have quietly stolen the spotlight. Since spring, silver has surged, and miners have gone vertical, outpacing the metal itself. ETFs tracking gold and silver miners have broken through decade-long resistance levels, signaling a structural breakout. Historically, miners outperform gold during powerful bull phases, and momentum models suggest this time will be no different. Analysts project that silver could breach the $50 barrier, with targets in the $60-$70 range by year's end. The metals sector is no longer sleeping, it's accelerating.
Momentum already broke out of its what you call a sleepy range, yet a positive trend. Go back to 2015 low, and this is, most people wouldn't believe this, even up through January, before we started to explode recently, GDX was matching, if not beating, what gold had done since the late 2015 lows. People don't recognize that because in 2020 we had a surge where the miners beat the pants off gold. But then since mid-2020 through 23 and into 24, they underperformed. In other words, they went up, but they didn't go up as much as gold. And then suddenly in March of 24, we put out a report saying gold then was pushing at 2,000 again, which it had done multiple times. We said, okay, we're waking up. Things are going to take off. And we did, and in layers still. There's a point at which you don't go in layers anymore. There's a point at which finally the incremental ends and you go into more chaos, more vertical nature. And that's largely due to these other markets. But yeah, the gold miners have already broken out. When you look at it, even if you look at a price chart, take a SIL, for example, Silver Gold Miners ETF, or GDX. Go back to the 2011 high, you'll see the drop. And you could draw a line across GDX, for example, that comes through at, let's say $43, $44 area. There was a low that came off the high in 2011, then bounced around that level, and then went through it. And after that, you spent years trying to get back up through it. Okay.
What's unfolding isn't limited to silver or gold. It's a broader reallocation of capital toward undervalued assets. For decades, U.S. equities absorbed the lion's share of global investment flows. But today, with valuations stretched and economic risks rising, money is seeking safer ground. Commodities, particularly industrial metals, are drawing fresh attention. The same dynamic is visible in copper, lithium, and rare earth miners, all rallying together, suggesting this is less about fundamentals and more about survival. Investors sense the Fed's safety net won't hold this time. When capital runs for cover, it doesn't trickle, it floods.
You got up through it months ago. So even price broke out. Momentum already said before that you're gonna do it. SIL, for example, even has a more pristine base on a price chart. Again, momentum spoke before this. But if you look at a SIL chart, go back 10 years, you'll see the same level hit. We blew through that a month or two ago, and we've gone vertical since. So it's really a fresh breakout for the miners when you look at the price charts. It's not something aged that needs to correct. And we're gonna, I have no question in my mind, we're gonna take out the 2011 highs in GDX and SIL, etc. And you can see the percent further gain that involves, which is not actually any more dramatic because we've already gained a lot. But that'll just put them, back above what gold was at 1920 in 2011. It was above there in 2020. It got up to 2070 or something. So they're finally catching up to gold in terms of their own historic prior price highs. But I think they're going to lead from here on out in terms of percent gain. In fact, our projection is that basically over the next year or two, probably, the gold miners will triple in performance relative to gold. They're far better place to be. Silver will at least double in performance, if not more, than gold in this next phase. So yeah, gold is the mama. And when it comes out of this range-bound situation, it's been in since April, people will wake up and say, my golly, that's, I got to get in, 2,500, 3,500 gets taken out, for example. Then they'll wake up. Momentum says, don't wait. Already be there. But gold isn't the place to be. This time around, it's going to be silver, gold, and silver miners. They'll vastly beat gold.
The parallels to past tombstone events are striking. Stocks may look healthy on the surface, but the Fed's pivot suggests underlying fragility. If equities roll over, the public could suddenly wake to opportunities in silver, gold, and miners, small markets that can skyrocket with relatively little inflow. Historically, once the crowd joins, rallies turn parabolic. Momentum models already flash green for metals while flashing red for equities. If silver clears $50 and mining ETFs reclaim 2011 highs, a flood of latecomers will pour in. The stage is set. Equities wobble, commodities rise, and metals may lead the next decade.
When you pierce a hole in the price action of the stock market, which momentum says you're already broken, price is teasing you with a marginal new high. It did the same sort of process of a marginal new high in late 2007, of a marginal new high in mid-2000, after we put out a sell signal in January 2000, made a marginal new high. But it was false. Momentum said, no, you're broken. Sorry, guy. Price went up and said, oh, it made a new high. It was a trap. And I think, and also we had those rate cuts, as we talked about earlier. I think we're in the same position now. The issue is when you start to break that beast, right now, the only thing the average middle-class guy on up has to smile about is, hey, my 401k, my retirement account. It's, oh boy, I made a new high, because if it's linked to the S&P, let's say. They're smiling. It's the only thing they can smile about. Consumer prices are about to reassert themselves. Our work on the Bloomberg says you're about to have another upwave in commodities, particularly gasoline. Be a politically sensitive upside.
Right.
A possible risk in the bond market to spark the stock market. So in other words, you could upset a lot of notions with breaking the stock market and helping accelerate the money flow. Like you said, it's trivial. But I bet that you got to get GDX above the 2011 high, which is not all that far above us right now, and SIL and so forth. And suddenly at that point, you might see the public, or silver above 50, for example. The public wakes up and say, golly gee, my buddy down the street who told me to buy this stuff months ago, and I laughed at him, he was right. You know, and you get the instead of a trivial trickle, you get a flow. And the thing is that these markets that we're talking about are small.
Yeah.
Trivial, you know, and it doesn't take much money to blow the gold and silver miners off the page, and expect it. Because we're down to, there's very few alternatives, if any, that compare to the monetary metals, especially when we break the equity markets.